Imagine waking up to find out that the US government just got the green light to borrow even more money. And now Wall Street is bracing for a flood of new short-term debt. If you're wondering what this means for your investments, your savings, or even the broader economy, you're definitely not alone. Let's break this down. Recently, Congress passed a massive spending bill, what's often called a mega bill. Now, with new programs to fund and existing obligations to meet, the government needs cash, and fast. The quickest and most common way for Uncle Sam to raise that kind of money is by issuing what's called Treasury bills, or T-bills for short. These are basically short-term IOUs from the government, promising to pay back investors in a few weeks or months, plus a bit of interest. So what's the big deal about selling a mountain of T-bills all at once? Well, here's where things get interesting. When the government sells more debt, it's essentially competing with everyone else who needs to borrow money. Businesses, homeowners, even cities and states. And just like in any market, when supply goes up, prices can go down. In the world of bonds, that means interest rates might rise. Let's zoom out for a second. The US government has been running a deficit for years, which means it spends more money than it brings in from taxes and other sources. To fund that gap, it borrows. In fact, as of 2024, the national debt has soared past $34 trillion, a mind-boggling number that's honestly hard to even wrap your head around. The Congressional Budget Office estimates that the government will run a deficit of around $1.6 trillion this year alone. That's a lot of borrowing that needs to happen, and a lot of debt to be absorbed by the financial markets. With the passage of this latest mega bill, the Treasury Department now has to hit the market big time. Analysts expect hundreds of billions of dollars in new short-term debt to be auctioned off in the coming months. And Wall Street is laser-focused on one key question. Who's going to buy all this new debt and at what price? Let's talk about buyers for a second. Historically, the demand for US Treasuries, especially short-term ones, has been pretty strong. That's because T-bills are seen as some of the safest investments in the world. They're backed by the full faith and credit of the US government, which, despite its fiscal challenges, has never defaulted on its debt. Big banks, money market funds, pension funds, foreign governments, all of them park huge sums in T-bills because they're low risk and highly liquid. But here's where things get tricky. When so much new supply hits the market at once, even the safest investments can face some headwinds. If investors think there's just too much debt out there, they might demand higher yields. That's the interest the government pays to borrow money. That, in turn, can ripple through the entire financial system. Higher yields on T-bills can pull money away from riskier investments like stocks or make borrowing more expensive for businesses and consumers. This isn't just a theoretical concern. We saw something similar last year when the US briefly flirted with a debt ceiling crisis. After the government passed a deal to avoid default, the Treasury unleashed a wave of new bills into the market. For a few weeks, yields on short-term treasuries spiked, and there were worries about whether the financial system could smoothly absorb all that new debt. Ultimately, things calmed down, but it was a reminder of how delicate the balance can be. So, what will happen this time? A lot depends on demand. On one hand, with interest rates higher than they've been in years, T-bills actually look pretty attractive to investors right now. Money market funds in particular are sitting on record amounts of cash, and they tend to scoop up T-bills when yields are juicy. On the other hand, if the supply grows too fast, or if investors get spooked by the sheer scale of government borrowing, yields could climb even higher, or in a worst-case scenario, there could be disruptions in the market. It's also worth considering the ripple effects. When the government pays more to borrow, that sets a benchmark for interest rates across the economy. Mortgage rates, business loans, even credit card APRs, all of those can move higher. That can cool off economic growth, slow down the housing market, and make it more expensive for companies to invest and hire. And there's a bigger, longer-term question here too. As the US continues to run large deficits and pile on debt, at what point do investors start to worry about America's fiscal health? For decades, the dollar and US Treasuries have been the bedrock of the global financial system. But as the debt grows, so does the anxiety about how sustainable it all is. For now, most experts think the market can handle this surge in short-term debt. The U.S. still enjoys a unique status as the world's reserve currency, and the financial system remains deep and resilient. But it's a trend worth watching closely. If cracks start to show, for example, if yields spike too far, or if there's a lack of buyers at Treasury auctions, that could be a signal that the market's patience isn't unlimited. So, as the Treasury prepares to unleash this tidal wave of new debt, Wall Street and Main Street alike will be watching closely. Will the markets absorb it smoothly, or are we headed for a bumpy ride? Only time will tell, but one thing's for sure. Every IOU the government writes today is a bet on tomorrow's prosperity, and the world will be paying close attention to see how that bet pays off.